The futures this morning are pulling back after another pretty good week, but we're going to talk fixed income. Joining us now, Jay Berry, J.P. Morgan, head of global rate strategy. I'm warming up to your. I think you get sold short, the whole fixed income area, Jay, because the market's been doing so well. I've heard you can get 7%, pretty much not necessarily risk-free, but you extend duration a little, maybe not, treasuries, and that's about what the market can do if it just cools off a little for the next couple of years. Do you agree? Should we be increasing our fixed income component of a balanced portfolio?
Morning, Joe. Well, I think the days of higher yields are here to stay, because I think if we even look at what the Fed did last week in lowering rates, another 25 basis points, and we expect further cuts over the balance of this year, policy rates are going to remain much more elevated than they have been over the last 15 years. And then I think longer out the curve, as you made the point about extending duration, we're in a world in which the demand for risk-free assets had shifted away from central banks and foreign investors and U.S. banks towards more price-sensitive investors like asset managers and hedge funds. And I think it leaves scope for long-term yields to remain more elevated as well. So that probably does mean that you're likely to be able to capture better returns in fixed income than we have been for most of the post-GFC period. I think that's about right.
Right. And I'm not going to ask you if the stock market's overvalued, but certainly for a percentage of the portfolio, look at insurance companies and people where the money, the return of the principal is more important than the return on principal sometimes. Fixed income can certainly fill that bill. Since the Fed cut, not significant maybe, but rates on the 10-year have been moving up.
Yeah, and I think it's really a reflection of the Fed's asymmetrically dovish reaction function here. Just like last year, the Fed has really prioritized its labor market mandate over its inflation mandate. And I think if we sat here at the beginning of the year expecting the Fed to be lowering rates into what is likely to be 3% core inflation later this week, I think it would have been hard to consider. But given the way the pace of private payroll growth has slowed, that the unemployment rate's been ticking up once again, I think the market's reaction indicates that this is likely to result in better growth and higher inflation outturns in the future, which has helped rates move back a little bit higher over the course of the past week. But the magnitude so far is much less than what we saw this time last year. And I think that makes sense as well, because we also had at the same point last year not just the expectation that the Fed would support the expansion, but also the shift in fiscal expectations as we moved into the presidential election. So I think there are some parallels here, but it's not likely to be a complete repeat versus what we saw last year, because the main differentiating factor right now is we've been in this very unusual spot with the labor markets, where the pace of private employment demand has been sitting under a 1% annualized run rate for basically most of this year. And it's been pretty much unheard of in kind of modern history to see labor demand this weak for a substantial period of time.